Welcome to part 2 of our lesson on monetary policy. We begin this one with a look at implementing monetary policy. So, to change the money supply and interest rates, the Federal Reserve, called the Fed often for shorthand here, the Fed relies usually on open market operations. There's other tools that they can use as well, but most of our focus here is going to be on what are called open market operations, which the Fed does engage in often. Open market operations refer to the Federal Reserve, the Fed's purchase or sale. So they could buy or sell bonds through transactions in the open market, hence open market operations, not through closed doors. Federal Reserve, through the same bond markets you could buy bonds from, the Federal Reserve could buy bonds from. Right? The open market operations, the Federal Reserve will buy or sell bonds in order to influence the money supply and interest rates. So the question, of course, that we're going to be looking at is what happens when the Federal Reserve buys bonds? Why would this matter? The Fed can buy or sell securities, bonds. When they do this, they increase or decrease the money supply. The way I like to think about this myself is imagine the Federal Reserve has a giant vault of money and a giant vault of bonds. Right? The Federal Reserve, at any time they want, can take some of the money, buy bonds. The money now goes into the money supply, and what they end up getting is bonds into their vault. Or vice versa, because they already do own a lot of bonds in their vault, they can take bonds in their vault, sell them, they get paid money for them, they put the money in the vault, and the money is now out of the money supply, right? That's a way the Federal Reserve can easily increase or decrease the money supply. So if the Federal Reserve sells bonds, they're cutting the money supply. If they buy bonds, they're increasing the money supply. So when the Fed wants to increase the money supply, it purchases U.S. government securities. Mostly. There's discussions the Fed can buy things other than U.S. government bonds. For the purposes here, we're only going to think about the idea that the U.S. would buy, or that the Federal Reserve would buy government bonds. By doing this, it adds reserves into banks, right? The bonds are owned by private investors. The government wants to increase the money supply, so it buys some of those bonds and pays money for them. Now there's more money in checking and savings accounts, which can add to the U.S. money supply. If it wants to decrease the money supply, it just does the opposite. It sells some of the bonds that it has, gets some money and takes it out of circulation. Right? It takes away reserves from banks. So the Federal Reserve can add or take away reserves from banks by the process of buying or selling government bonds. So what would this look like? Here's a graph with a downward sloping demand curve for bonds and an upward sloping supply curve for bonds. So we have a supply curve, and here we have the supply of bonds being increased. So this would be a case where the Federal Reserve has bonds in its vault and sells them. So the number of bonds then on the market increases. The number of bonds on the market goes up. Well, in the process, of course, the supply of bonds has shifted, right? Because the Fed has dumped a lot of new bonds onto the market. Well, the supply goes up. Standard economics, right? What happens to the price? Price drops from $950 to $900. And that's what happens with our bonds, the price of bonds. So rising bond prices mean falling interest rates. And we see this, right, from S1, the initial supply curve, price of $950, and they've computed that that means an interest rate of 5.3% because the bond is bought for $950 and then sold, and then it is redeemable at the end of a year for $1,000. It's a 5.3% interest rate. With the increase in supply, we see a price dropping to $900, the interest rate increasing to 11.1%. Why does this mean that? Well, the bond is redeemable for $1,000 at the end of the year. So the lower of a price you pay for it, right, the greater return you're getting on your investment. If you pay $900 for something and you get $1,000 back for it, you're earning more interest than if you paid $950 for something and got $1,000 back for it. So rising bond prices mean falling interest rates. Falling bond prices mean rising interest rates. So bond prices and interest rates have an inverse relationship. Okay, an example. I'd like you to work on these on your own. Customer buys a bond for $950 that can be redeemed in 1 year for $1,000. What is the interest rate? And what happens if the interest rate if the price of the bond increases to $960? So this would be a case where the Federal Reserve actually is cutting back on the supply of bonds. That pushes the price up for bonds. What happens to the interest rate then for bonds in this particular case? Okay, I'm just going to go into Excel to work through these. So if we had a bond that we bought for $950 and it was redeemable in a year for $1,000, what's the interest rate? Well, you get $50 of income from a $950 purchase price. Let's put this in percentages. I've got 5%, and I'll move the number out here. 5.3%, right? Well, what happens if the bond price increases to $960? Well, now we only have $40 worth of income we're earning from a purchase price of $960. Because we discussed bonds and interest rates have an inverse relationship, we know because the price is going up, the interest rate drops. By how much does it drop? Well, it goes from 5.3% to 4.2% in this case. So we take $40 of, as the earnings on the bond divided by the $960 purchase price. We're looking at an interest rate of 4.2%. So an open market purchase by the Federal Reserve will increase the money supply, right? If Fed is buying bonds, it's paying cash for the bonds, takes the money from their vaults, the vaults I imagine them having their money in, puts it into the money supply, and money supply goes up. But the money supply going up, bond prices will also go up because the Fed is buying bonds, which decreases the supply of bonds. Decreasing the supply of bonds drops the interest rates. So an open market purchase by the Fed, what does it do? Money supply up, bond prices up, interest rates down. Open market sale by the Federal Reserve does exactly the opposite. Money supply goes down, bond prices also drop, interest rates up. So open market purchase or open market sale, obviously they do opposite things, employed for opposite reasons.